pro day traders asking, who was your mentor? Guys, I wish I had mentors. I can't say that I did not learn things in little pieces from people throughout the years. But remember, I started in 1981. My first trade is in 1981. There was nothing. There's no internet. There's no courses. There's no seminars. There's no books. There's no articles. There's nothing. Guys, first of all, equity trading wasn't even the thing. It was bonds. Bonds were the dominant thing when I first started. Like equities were like, you're interested in equities? You're interested in stocks? Like for what? It didn't, as we moved, I started kind of at the right time because we were on the end of that bond thing and equities exploded in the middle of the 1980s. But even when you got hired on Wall Street, nobody wanted to go to an equity desk like that. What was that? It was all about bonds. And remember I don't remember, I'm talking to you like you're my age, but in the 70s, the market was trapped and people thought that it would never break 1,000. So if you go back to charts of the Dow or the Dow Jones Industrial Average during the 70s, you'll see this flat market. I mean, you'll see it drop and then come back. It would double, it would drop to 500 and come back to 1,000, drop to 500, come back to 1,000. So, you could play it that way, but no one ever thought that it would ever break. Everyone thought that 1,000 was the ceiling. So it's like, this market has no upside. Like, why do I want to be here? Now, in contrast, bonds, we have been in a 300-year bull market in bonds, 300 years. Bonds have been going up for 300 years. All the way from interest rates going to zero. So the way you have to look at bonds is in reverse to the interest rate. So now bonds yield zero. So we've gone is almost, you can go negative, which some bonds are now negative. Over $100 trillion in bonds are negative, if not more. But so you can pass zero, but not by that much. So there's not much more movement up. So think of bonds in reverse. Interest rates drop, bonds are going up, right? Now we've gone from 40% interest, 30%, 20%, 15, 10, 5, and that's 300 years of bonds going up all the way to zero now. So the future for bonds is zero. People thought that equities had reached their peak at 1,000 in the 70s. So everybody was a bond trader. The junk bond era. Everybody was bonds. So I came into the equity world when nobody wanted equities. Nobody was interested in that. You were at the bottom of the totem pole if you got involved in equities. It was like people assumed like, damn, did you flunk out of school or something? Like if you were in a Wall Street firm on an equity desk, it's like, did you graduate at the bottom of your class? What happened? What happened to you? This was always the case with equities, even all the way back in the 1920s and 30s, when the way you traded equities was to go to a bucket shop, like an old OTB. If you're from New York, you know what the old OTBs were. Like that was where the low-level gamblers bet $2 on IBM, but can you give me $20 for my $2? Like bonds were for gentlemen. Top hat, not equities. It's only in the 80s, mid 80s, late 80s into the 90s, 2000s, equities came on top of bonds, right? And so are we at the end of the equity market boom? Like we're at the end of the bond? I would say closer to the end than the beginning. What are we at the beginning of? Somebody type it for me. So if we're at the end of the 300-year bond run, if we're closer to the end in the equity run, right? Equities came into existence 1600s. I think 1600s. Am I right with that? No. Bonds came into existence in the 1600s Equities a couple hundred years later. Or am I right? No, maybe equities in the 1600s as well. Like it started in Portugal, right? The fractional ownership of the voyages, and they would oversell the voyages, so they would sell 400%. Right? But the future is Bitcoin. That's a baby. That's 12 years old. It cracks me up when people say, but Bitcoin's a bubble. No, idiot. The bond market's a bubble. That's 300 years old. Gold, 6,000 years old. That's bubble. What are you talking about? Like, that's like saying LeBron James was a bubble at 12 years old just because he was great. At even 12 years old, he was great. All right, LeBron James is 12 years old. He's topped out. Are you kidding me? Dude, Apple's been running for 44 years. What are you talking about? Microsoft's been running almost 46 years. Amazon's been running 24 years. Google's been running 22 years. What are you talking about? 12 years? What world do you live in? And let me tell you something about this word bubble. There's a technical term for a bubble that once it's burst, it's gone forever. That's what a bubble is. The tulip bubble. That tulips never became a thing anymore. When a bubble bursts, it's over forever. It doesn't keep coming back. How that's the actual definition of it's not a bubble anymore. If something crashes 85, 90% and comes back, that's living proof. Whoa, I thought it was a bubble. It's not a bubble now. That's what Amazon did 4 times. But when Amazon crashed 95% and came all the way back, people who know the definition of a bubble say, okay, we thought it was a bubble. It's not a bubble now. Like, bubbles don't come back, guys. If someone says that, they're not intelligent enough to know what the financial definition of a bubble is. And just because it's high or up a lot doesn't mean it's a bubble. Imagine calling Apple a bubble in 1997. Just because from its price in 1992, when it was 12 years old, it was up tremendously higher from its IPO price in 1980. But imagine calling Apple a bubble in 1992. Ridiculous. It's the future. Okay, back to your questions, guys. Zero risk with Bitcoin in the long term. I would say nothing has zero risk, but I would say that based on historical numbers, that it has one of the lowest risks. People associate volatility with risk, but that's a negative view. I mean, volatility is positive if played the right way, right? So a dollar cost averaging plan turns volatility in your friend. The last thing you want to do with a non-volatile asset is dollar cost average into it. That's dumb. But if it's volatile, the dollar cost average wins. The dollar cost averaging method wins. It says, okay, volatility, I've just bought you. Now go work for me. That's what dollar cost averaging does to volatility. It turns volatility into the employee. You understand? But, people associate volatility with risk, but volatility is opportunity. And of course, everything young is going to be volatile. I mean, Amazon was extraordinarily volatile in the beginning years. Wow, I traded it. That thing would go up $80 in an hour and then crash back to 15. I said, the thing was just at $80 and now it's at 15. Like, you have no idea what volatility is. If you traded stocks during the dot-com bubble, whew, oh my God. Talking about volatility, Bitcoin's nothing compared to that. You know?